Welcome to this tax mock test or sim test. This question is called Sondezi. Please, before you continue with this question, make sure that you've attempted it yourself first and marked yourself to the suggested solution so that you can identify where you're going wrong, what the issues are, so that when you're watching this tutorial video, you can really focus on where you've got issues and problems. Because it doesn't help if you just watch the video, if you haven't attempted it yourself first. It always looks easier and better when the lecturer does it. You need to attempt it yourself first so that you can test your knowledge before you go into the test, the exam. So please do attempt it before continuing with this video and enjoy the question.
So this question consists of two related parts. Part A, 28 marks, and part B, 12 marks. Alright, so let's take a look at it. So I'm going to start with the reading as well, obviously as we usually do. Mike Sondezi, 38 years old, a South African resident, carries on a business as a sole proprietor. He manufactures unique pieces of furniture based on customers' personal requests. He also restores antique furniture. Word of his craftsmanship spread quickly, and he now boasts having clients in countries outside of South Africa. He is a registered VAT vendor with a 2-month tax period. Okay, so January, February, March, April, or December, January, whatever the implication is, or whatever the period is. You are a manager at a firm that provides accounting and tax services to small and medium-sized businesses. Mike has requested tax advice from your firm, and you have been appointed to assist him. Your assistant has already dealt with a number of Mike's queries, but has brought some issues for your attention. Okay, so issue 1. On 6th of January 2019, Mike sold a custom-made desk to a wealthy businessman in Bryanston, Johannesburg, for 189,000 rands, including VAT. So guys, make sure you see, this is after 1 April 2018, so the VAT is 15%. Or actually from 1 April. Okay, so remember guys, that's important. You need to pay attention if it's 15 or 14%. The businessman was delighted with the quality of the desk, and on the 7th of February 2019, he arrived at Mike's business premises and handed Mike an envelope full of cash as payment for the desk. Mike did not count the money until the businessman had left, and found that the businessman had paid him 210,000 rands. Okay, so instead of the businessman paying him 189,000 rands, he paid him 210,000 rands. So that's an excess amount, so he's overpaid him. And they said there was a thank you note included in the envelope, so maybe this guy just said thank you and gave him a bit of extra. Mike repeatedly tried to get in contact with the businessman as he wishes to repay the excess amount, but he has been unsuccessful in reaching the businessman. Okay, so immediately when you're looking at this, you should remember that we have a deemed out or deemed supply section, section 8 to 27, that says 4 months to repay excess. And then you calculate output tax. So basically what it says, so this is obviously very shorthand, but you've studied this, means once they pay you, once you received an excess amount, you've got 4 months to repay that person. If you have not repaid them after 4 months, then you have to account for output VAT on that. Now, if you look at this person, he paid on the 7th of February. Okay, so that's important for you. So 7 February, so 7 March, April, May, June. So it's to 7 June. Right, that is 4 months. So you have to account for the VAT in June at the end of that VAT period, basically. Okay, so just be aware of that. So we have to now see, we don't know what VAT period yet we are looking at. Obviously you do know because you've looked at it, but that's the question that you'd have in the exam. What VAT period? Because also remember guys here, I'm just going to make a comment here, this supply is the earlier of invoice or payment. Invoice 6 Jan, payment 7 Feb. So do you account for this 4 months, this section 827, this 4 month? Do you account for it from 6th of Jan or from the 7th of Feb? Okay, so I'm asking it specifically because you might have now confusion. So remember, first thing, this actual output VAT, you would have calculated on the 189,000 rands. That you would have accounted for on the earlier of invoice or payment, which is January, so you would have accounted for it in the January VAT period, whatever that period is. This Section 827 4 months rule is only once you've received the excess, because on the 6th of January you didn't know the person's going to overpay you, so it's only when you receive the excess, which is on the 7th of February. That's why we count from there. Okay. Issue 2. On the 15th of May 2019, Mike entered into a lease agreement with Machine Co. Limited, where Mike would lease an industrial sander from Machine Co. Limited at a cost of 7,000 rands per month for a period of 3 years. This agreement meets the definition of an installment credit agreement as defined in the VAT Act. And had Mike purchased a sander instead, the open market value would be 195,500. Now guys, we tell you here in this question, I tell you that it's an installment credit agreement. You might also have to determine it yourself. Remember, the requirement is given in the VAT Act. I can do part of it here because we don't have enough information. One of the information that you have to see is who takes responsibility and all of those things for this amount. But basically, one thing I just want to show you quickly, if you say 7,000 rands per month has been paid, so times 12 for a period of 3 years, that means that the total amount is 252,000 rands. This has an open market value, so that means including VAT, of 195,500. So the cash cost ex VAT, the VAT, and then interest. That's how we break it up. So that 195,500, if I say times 15 over 115, gives me 25,500 rands VAT. So that means the cash cost excluding VAT is 170,000. Now the difference between 252 minus 170 minus 2,500 is 56,500 rands, and those are finance charges. Now we have an installment credit agreement, guys. Remember, we account for it on the cash value. So this VAT amount over here that you calculated there, that will be the VAT. And you do it on the earlier of delivery or payment. Right, so what is it? What do you do here? This is deliberately also given to you for this. I want to illustrate it to you. What do you do here when you know you account for the earlier of delivery or payment? But you can see here they don't tell you anything. Then you have to assume that the 15th of May is that date, guys. Okay, issue 3. On the 8th of March 2019, Mike purchased an antique dining table from an elderly woman who was selling a home in order to move into a retirement village. The woman agreed that Mike could pay for the dining room table in 3 monthly installments of 30,000 rands, with the first payment being 8th of March 2019. Okay, so this is an elderly woman who's selling it from a home to move into a retirement village. The only thing we can assume here is this is a non-vendor. Okay, it's a non-vendor. So what can we claim on that? Notional input tax. Okay, what is the rule there? You claim it on the lower of cost, market value, and the timing rule, claim as it is paid. So that's important. So 3 monthly installments, so 30,000 times 15 over 115 is what you would claim on each installment. Then, Mike worked on the antique dining table to restore it to its former glory and to make adjustments, and Mike incurred 14,000 rands. Right, so you can claim input tax on that, that's a normal expense. On the 17th of May, Mike sold the dining room for 500,000 to a person staying in Germany. And he shipped it to Munich directly, so this is an export. Now, usually, it is 0 rated under section 11.1a, but this is one on which people claim notional input tax. You have to remember there's a proviso in section 11.1. that says basically pay back the notional input tax. Doesn't say that exactly, guys. It basically tells you in that the proviso, section 11.1a does not apply if you claimed input tax under paragraph 1b or paragraph b of the input tax definition, which is the notional input tax. So that's important for you to be aware of. This is a special rule though, and it's a little bit of a trick if you're not aware of it. Right, issue number 4. Mike employs 2 assistants whom he pays 8,000 rands a month. There's no VAT on remuneration. How do we know this, guys? Just as a reminder, section 1, definition of an enterprise. On the 25th of May 2019, Mike sent the 2 assistants to Cape Town where they would perform the repair work on a client's furniture which has been damaged in a house robbery. The client was invoiced 80,000 rands for these services. Mike's assistants had to spend 2 nights in Cape Town. The following costs were incurred in respect of this trip. All amounts include VAT. Alright, so they had to be away from home, can you see? Spend 1 night away from their usual place of residence. So basically what this would mean is, remember, input tax is not the night on entertainment if obliged to spend a night away from usual residence. Right, so then they give us this table here and they say, can you claim it? So hotel accommodation is commercial accommodation, but it could be considered entertainment. Usually it can be considered if it's a holiday or something like that, but in this case, this doesn't matter in any case. You can claim it because of the fact that they are obliged to spend a night away from home. Meals at a restaurant, definitely entertainment, but 1 night away from home. Remember, you can only claim it for yourself, so Mike could have claimed it for himself, for your staff, for independent contractors which you basically employ, so independent people working for you. But you can't ever claim it on things to a client, for example. Car rental in Cape Town. Right. Input tax denied. It's a motor car. Buying or renting a motor car, input tax denied. Insurance on a rental car. That you can claim. Remember, the common mistake students make is to say that that is the same as a motor car input tax denied. That's incorrect. Return flights, they do charge you VAT in flights, so you can claim it. Issue 5. Mike owns a 2-story building, Building A in Randburg, Johannesburg, which he purchased in July 2018, so after 1 April 2018, from a VAT vendor. His furniture workshop fills the ground floor and part of the upper floor. Mike shares an apartment with his wife and son in the rest of the building. Okay, so this building, he stays in it with his family and also uses it for his business. SARS has accepted that 70% of the building pertains to the workshop. Okay, so this is our apportionment that we have to apply. It's not for all of his things in his business, it's just for everything that relates to this building. Right, so that's the trick here. So on the 18th of April 2019, there was an electrical surge and the building's air conditioning unit burned out. Mike submitted a claim to his insurer and received a payment of 120,000 rands in his bank account. Section 8.8 says that is a deemed disposal. This is an indemnity award. Right? In his bank account the next day, the air conditioner serviced the entire building. And Mike had claimed the appropriate input tax when he had originally purchased it. Right. So he would have claimed 70% input tax. Now, when you basically get rid of this aircon, okay, can you remember the rule? Output tax is always at 100%, except for change in use right? That's not the one most common. Fringe benefits, that's one I want you to be more aware of. And of course, indemnity awards. So this means if you only claim 70% of it, when you calculated this output tax, it will be times 70%, because indemnity award is one of the exceptions. Issue 6. In April 2019, Mike decided to sell the building he owned in Randburg, Building A. So issue 5. Okay, so this building wants to now sell it. He found an interested buyer and sold the building on the 4th of May 2019 at its open market value. So that's the value including VAT. The buyer settled the full purchase price for a bank loan, which Mike received on the 27th of May 2019, and the building was registered in the name of the buyer on the 4th of July 2019. Important information relating to the building, Building A, original purchase date, original cost, how it was used for, and the selling price. Okay, so a couple of important things here when we sell this. First up, output tax is always calculated at 100%. Okay, so that selling price over there, there will be output tax on that, 2.2 million times 15 over 115 times 100%. Okay, but when you purchase it, you only claimed input tax on 70% of it, which is the workshop. 30% is a personal residence. So you would have only claimed input tax of 70%, but we are accounting for output tax. So I'm going to just say here, remember section 16(3)(h). Always to consider that. Remember, guys, you always look. If we are selling an asset, that's always a trigger. We just look, how much input tax did I claim? If I claim 100%, section 16(3)(h) is not applicable. But if it's not, if you claim less than 100%, then you should consider section 16(3)(h). Important also here, guys, there's a timing rule in section 16(4). Right. Remember, there's a general timing rule. Section 9(3)(d) says earlier of registration or payment. But then there's I want to call it an actual timing rule, when you have to account for it. And if you are a VAT vendor selling it and there's output tax, you account for it on payment. Okay, account for payment. I'm just going to write here, we don't look at registration date. Remember, we only look at the registration date when the seller is a non-vendor, and then we are looking at it from the buyer's perspective, because the seller won't account for that. Issue 7. Mike purchased 2 new properties in May 2019 in order to replace Building A. Mike purchased a house for him and his family to live in at a cost of 1.4 million. As it was purchased from a non-vendor, there was no output VAT included in the cost price. Mike paid across the necessary transfer duty. The house was purchased on the 20th of May and it was registered in Mike's name on the 7th of June. Mike paid a deposit of 400,000 and settled the outstanding balance on the 10th of June. Well, this is all fine and dandy, but this is a personal residence. So, there's not going to be any VAT, and it will be a base cost for your personal residence eventually. Mike also purchased a new building to use as a workshop for his furniture business. Okay, this is more important. The building had a cost and open market value of 1.5 million. It was purchased from a non-vendor. Aha! And thus no VAT was charged. So, you can claim notional input tax. That's the first thing that you need to remember. The second thing that you need to remember is that we again have this actual timing that says can only claim when registered, and then can only claim on amounts paid. But that is the order. Only once it's been registered and only once the amounts have been paid. So the building was purchased on the 25th of May. He paid a deposit on this date. Okay, so 25 May, deposit. The building was registered on his name on the 15th of July. Registered. and then he settled the outstanding balance on the 20th of July. So 20 July, $1 million, and the deposit was 500,000. So you can claim from this date. At that date, you would have paid the deposit, so you can claim on that, and then once you pay the R1 million, then you can claim. Mike settled that same balance, and he will use it solely for the purpose of his workshop, so it means you can claim 100% of the input tax. Okay, guys, up to there. I'm going to start the recording now. We'll do the required for part, or the reading of part B in a separate recording.